When people ask about the favorite stocks of financial celebrities, they often expect a list of tickers that can be copied, bought, and turned into fast profits. That expectation misses the point entirely. For legendary investors, a favorite stock is rarely about a symbol on a screen. It is a reflection of how they think about business-quality risk time and human behavior. The stock is simply the visible outcome of an invisible framework. To understand why certain stocks repeatedly appear in the portfolios of financial icons, we must first understand what they are actually looking for beneath the surface. One of the most consistent patterns is a preference for businesses, not trades. Warren Buffett's long-term holdings, such as Coca-Cola, Apple, and American Express, are often misunderstood as brand bets. In reality, Buffett is attracted to durable cash flows, pricing power, and customer habit. Coca-Cola is not just a beverage company. It is a global distribution and branding machine that embeds itself into daily behavior. Apple is not merely a technology firm. It is an ecosystem with switching costs, loyalty, and recurring revenue. These stocks became favorites not because they were cheap at every moment, but because they could compound value quietly over decades with relatively low risk of permanent capital loss. Another recurring theme among financial celebrities is simplicity of understanding. Benjamin Graham favored companies with clear balance sheets and understandable operations. Charlie Munger repeatedly emphasized that complexity hides risk. Stocks become favorites when their economics are easy to explain and difficult to disrupt. This explains why many legendary investors avoided industries they did not understand for years, even when those industries were popular. A favorite stock is often one where the investor can confidently answer three questions: how does it make money? Why will it keep making money? And what could realistically destroy it? For macro-oriented figures like George Soros, favorite positions are often not tied to individual companies, but to structural imbalances. His most famous favorite trade betting against the British pound was not about currency preference, but about recognizing an unsustainable system. In this framework, a favorite stock or asset is one where economic reality and political constraints are misaligned. Soros is less interested in owning something forever and more interested in moments where being right matters disproportionately more than being wrong. The common thread remains the same clarity about risk and asymmetry, not excitement. In more recent decades, financial celebrities such as Ray Dalio have emphasized portfolio balance rather than single favorites. Dalio's approach reduces dependence on any one stock by favoring assets that respond differently to growth, inflation, and policy. Even here, however, favorites emerge implicitly. Assets that perform well across regimes or that hedge systemic risk are treated with special importance. The lesson is subtle. Sometimes the favorite stock is not the one with the highest upside, but the one that protects everything else when conditions turn hostile. Across all these approaches, one truth stands out clearly. Favorite stocks are not chosen for narrative excitement, but for behavioral reliability. Financial celebrities want businesses or assets that behave predictably under stress, generate cash without constant reinvestment, and do not require perfect conditions to survive. This is why so many favorites appear boring to outsiders. Boring is stable. Stable is survivable. Survivable is what allows compounding to work. Part 1, therefore, is about reframing the idea of a favorite stock. It is not about popularity or recent performance. It is about alignment with an investor's philosophy and temperament. Stocks become favorites when they reduce decision fatigue, emotional pressure, and the need for constant monitoring. They fit cleanly into a long-term framework rather than demanding continuous justification. And it is precisely here when we stop asking, what stocks do they like, and start asking, why do these stocks fit their way of thinking that the deeper insight begins to form. Because the real lesson is not in the names themselves, but in the principles that keep those names in portfolios through booms, crashes, and long periods of boredom. And this is where the story naturally continues into its second half, because the true value of studying favorite stocks lies not in why they were chosen, but in how they are treated when conditions change. Financial celebrities do not fall in love with stocks. They fall in love with process, and they are willing to part with even long-held favorites when reality shifts. This discipline is what separates enduring success from blind loyalty. One of the clearest lessons from studying famous portfolios is that favorite stocks are held with patience, but not with denial. Buffett held Coca-Cola for decades, but he has also exited or reduced positions when competitive advantages weakened or capital could be deployed more effectively elsewhere. The favorite status of a stock does not grant immunity from review. It earns deeper scrutiny, not blind trust. When assumptions change, financial celebrities adjust quietly without drama, because identity is not tied to any single holding. Another important insight is how favorite stocks are used to reduce decision frequency. Holding high-quality businesses allows investors to avoid constant trading. This lowers transaction costs, tax drag, and emotional interference. The stock becomes a foundation rather than a speculation. This explains why many legendary investors concentrate their portfolios around a few core holdings. Concentration is not recklessness when it is built on understanding and durability. It is a way of expressing conviction without constant action. There is also a powerful lesson in how favorites behave during market stress. Stocks that remain favorites through crashes tend to share certain traits: strong balance sheets, loyal customers, and the ability to generate cash even when growth slows. Financial celebrities watch how their favorite holdings behave under pressure. Do they dilute shareholders? Do they maintain margins? Do customers stay? Crashes are not reasons to abandon favorites automatically. They are tests that reveal whether the original thesis was robust or fragile. Equally important is the willingness to let go. Many well-known failures in financial history came from treating a once great stock as untouchable. Legendary investors avoid this trap by separating emotional attachment from analytical judgment. A favorite stock is a privilege, not a promise. When better opportunities appear or risk increases beyond tolerance, they rotate capital without regret. This emotional neutrality is as important as analytical skill. Another subtle lesson is that favorite stocks often reflect an investor's life stage and goals. Early in a career, favorites may emphasize growth and learning. Later, they may emphasize cash flow stability and protection. Favorites evolve because the investor evolves. What remains constant is the discipline behind the choice, not the choice itself. This is why copying a favorite stock without copying the underlying context often leads to disappointment. When viewed together, these patterns reveal the deeper truth. Financial celebrities' favorite stocks are not secrets to be copied. They are case studies in alignment. Alignment between business quality and human behavior, between patience and discipline, between conviction and humility. And so the real takeaway from this deep dive is not a list of names, but a set of questions every investor should ask. Does this business earn trust over time? Does it simplify my decisions? Does it survive stress without demanding perfect conditions? And am I willing to let it go if reality changes? Those questions, not the stock tickers themselves, are the true inheritance passed down by financial celebrities. When they are applied consistently, the need for favorite stocks fades, replaced by something far more powerful. A repeatable way of choosing, holding, and releasing capital without self-destruction, allowing wealth to compound quietly while attention is freed for what truly matters over the long arc of time.